Money is a fundamental aspect of human society, serving as a vital tool for facilitating trade and economic interaction. At its core, money is defined as a medium of exchange that enables individuals to trade goods and services efficiently. Its primary functions include serving as a unit of account, a store of value, and a standard of deferred payment. The importance of money cannot be overstated. It simplifies transactions, allowing for the specialization of labor and the growth of economies. Without money, societies would struggle with inefficient barter systems, leading to limited trade and economic stagnation. The evolution of money has been shaped by human needs and technological advancements, reflecting the dynamic nature of our economic systems. Understanding the concept of money is essential to grasp the complexities of modern economies and the role it plays in our daily lives. As we delve deeper into the history of money, we will uncover its transformative journey through various forms and functions. The barter system emerged as the earliest form of trade, where individuals exchanged goods and services directly without any intermediary. This method relied heavily on the double coincidence of wants, meaning that both parties had to desire what the other offered. While it served as a foundational economic practice, the barter system faced significant limitations. For instance, it was often challenging to determine the relative value of diverse goods, leading to inefficiencies. Additionally, the lack of a standardized medium of exchange made it difficult to conduct larger or more complex transactions. As societies grew and trade expanded, these limitations became increasingly apparent. The need for a more efficient medium of exchange became clear, prompting the search for alternatives that could simplify transactions and facilitate trade on a broader scale. This paved the way for the introduction of commodity money, which addressed many of the shortcomings inherent in the barter system. Commodity money emerged as a significant advancement in trade, offering a more efficient means of exchange compared to the barter system. Early societies recognized the value of certain items, leading to the use of tangible goods like gold and silver, which were not only precious but also universally accepted. Gold, with its rarity and durability, became a symbol of wealth and power, while silver served as a practical alternative for everyday transactions. Other valuable items, such as salt and spices, also played crucial roles in trade, serving as commodities that held intrinsic value. The significance of commodity money in early economies cannot be overstated. It facilitated trade over long distances, established a standard for value, and contributed to the rise of complex economic systems. As societies evolved, the need for a more standardized and portable form of money became evident, paving the way for the next phases in the evolution of currency. Around 600 years before Christ, the ancient kingdom of Lydia, located in what is now Turkey, made a revolutionary leap in the concept of money by minting the first known coins. These coins, crafted from electrum, a natural alloy of gold and silver, featured standardized weights and stamp designs which ensured authenticity and value. This innovation transformed trade and commerce as it provided a reliable medium of exchange that was easier to carry than bulky commodities. The introduction of metal coins facilitated more complex transactions, allowing merchants to conduct business over greater distances with confidence. As these coins spread throughout neighboring regions, they promoted economic growth and stimulated trade networks. The impact was profound, as societies began to move away from barter and commodity money, paving the way for more sophisticated financial systems. This transition marked a significant milestone in human history, setting the stage for the evolution of money as we know it today. The invention of paper money during the Tang dynasty marked a significant turning point in the history of trade. Before this innovation, transactions relied heavily on metal coins and commodity money, which had limitations in terms of weight and portability. Paper money, introduced around the 7th century, provided a lightweight and convenient alternative. It allowed merchants to conduct larger transactions without the burden of carrying heavy coins. This revolutionized trade by facilitating commerce across vast distances, enabling merchants to engage in more extensive trade networks. The use of paper money also simplified transactions, as it could be easily printed and issued by the government, ensuring a stable currency supply. As a result, trade flourished, contributing to economic growth and the expansion of markets. The Tang dynasty's adoption of paper money laid the groundwork for future monetary systems, influencing not only China but also the world as the concept spread beyond its borders. The introduction of paper money in ancient China during the Tang dynasty marked a pivotal moment in economic history. As its benefits became evident, the concept began to spread to other regions, including Europe. By the late 13th century, Marco Polo's accounts of Chinese paper currency intrigued European merchants, leading to its gradual adoption. However, this transition was not without challenges. European societies were initially skeptical, as the idea of currency not backed by tangible commodities like gold or silver was foreign and unsettling. The lack of trust in paper money led to resistance and the establishment of stringent regulations. Additionally, counterfeiting became a significant issue, undermining confidence in this new medium of exchange. Despite these hurdles, the advantages of paper money, such as ease of transport and increased trade efficiency, ultimately prevailed, paving the way for its widespread acceptance and the evolution of modern financial systems. The establishment of banks marked a significant evolution in the financial landscape, providing a secure place for individuals to deposit their money. This innovation allowed for larger transactions, as banks could facilitate the transfer of funds between parties. Alongside this development came the concept of promissory notes, which acted as written promises to pay a specific amount of money at a designated time. These notes fostered trust in trade, enabling merchants to engage in larger transactions without the immediate exchange of physical currency. As businesses expanded, the ability to issue promissory notes meant that trade could occur more efficiently, with reduced risk. This system not only simplified transactions, but also laid the groundwork for modern banking practices. The trust established through these innovations encouraged economic growth, allowing for increased commerce and the development of complex financial systems that we rely on today. The rise of banks and promissory notes transformed the way people conducted business. The gold standard emerged as a crucial monetary system in the 19th century, linking currency values directly to gold. This system provided a stable framework for international trade, as countries agreed to convert their currencies into a specific amount of gold. The predictability of gold's value helped stabilize exchange rates, reducing the risks associated with currency fluctuations. As nations adopted the gold standard, it facilitated smoother trade relations, enabling countries to engage in commerce with greater confidence. The uniformity of currency value promoted economic growth, as businesses could plan and invest without fear of sudden financial changes. Furthermore, the gold standard encouraged the accumulation of gold reserves, which served as a buffer against economic crises. By establishing a reliable standard, it not only enhanced trust in monetary systems, but also laid the groundwork for globalization, allowing economies to interconnect and thrive in an increasingly competitive world. The Great Depression, beginning in 1929, had a profound effect on the global monetary system. As economies collapsed, unemployment soared, and banks failed, many countries faced severe deflation and a lack of confidence in their currencies. This crisis highlighted the limitations of the gold standard, which had previously tied the value of currency to a specific amount of gold. As nations struggled to stimulate their economies, they found that adhering to the gold standard restricted their ability to increase the money supply. Consequently, many countries abandoned the gold standard in the early 1930s. This shift allowed governments to print more money to support economic recovery efforts. The move away from gold-backed currencies marked a significant transformation in monetary policy, paving the way for the introduction of fiat money. This change fundamentally altered the relationship between governments and their currencies, leading to a more flexible monetary system aimed at preventing future economic crises. Fiat money refers to currency that a government has declared to be legal tender, meaning it must be accepted for the payment of debts. Unlike commodity money, which is backed by physical goods like gold or silver, fiat money has no intrinsic value. Its worth is derived from the trust and confidence that people place in the issuing government. The transition to fiat money began in the 20th century as governments sought greater control over their monetary systems. During this time, many countries moved away from the gold standard, which tied currency value to a specific amount of gold. This shift allowed governments to issue more currency, facilitating economic growth and responding to financial crises. The introduction of fiat money marked a significant change in how economies functioned, enabling more flexibility in monetary policy. Today, most of the world's currencies are fiat, reflecting a system based on trust rather than tangible assets. The introduction of credit cards and electronic banking has fundamentally transformed the way people manage and use money. Credit cards, first introduced in the mid-20th century, allowed consumers to make purchases without immediate cash, promoting convenience and encouraging spending. This shift not only changed consumer behavior, but also led to the growth of a credit-based economy, where individuals could access funds for larger purchases and manage their finances more flexibly. Simultaneously, electronic banking emerged, enabling people to conduct transactions online, pay bills, and transfer money instantly. This innovation reduced the reliance on physical cash and made financial management more accessible. With the rise of mobile payment systems and digital wallets, consumers can now complete transactions with just a tap on their smartphones. These advancements have not only streamlined personal finance, but also increased the speed and efficiency of commerce, reshaping the landscape of global trade and consumerism in profound ways. The emergence of cryptocurrencies marks a significant shift in the landscape of money. In 2009, an individual or group under the pseudonym Satoshi Nakamoto introduced Bitcoin, the first decentralized digital currency. Bitcoin operates on blockchain technology, which ensures transparency and security without the need for a central authority. This innovation has profound implications for the future of money. Cryptocurrencies challenge traditional banking systems by enabling peer-to-peer transactions, reducing fees, and increasing accessibility for unbanked populations. Furthermore, they introduce the concept of scarcity in a digital realm. As Bitcoin has a capped supply of 21 million coins, this scarcity can potentially lead to value appreciation over time. However, the volatility of cryptocurrencies raises concerns about their reliability as a stable medium of exchange. As more individuals and businesses adopt cryptocurrencies, they may redefine how we perceive and use money, paving the way for a more decentralized financial future. Cryptocurrencies present a mix of advantages and disadvantages that shape their role in the financial landscape. One significant advantage is decentralization, which allows users to transact without intermediaries like banks, fostering greater control over personal finances. Additionally, cryptocurrencies can offer enhanced security through blockchain technology, making transactions transparent and immutable. However, this security is often challenged by the risk of hacking and fraud, raising concerns about user safety. Moreover, the volatility of cryptocurrencies is a double-edged sword. While it can lead to substantial profits for investors, it also poses risks of significant losses, making them unsuitable for conservative investors. Furthermore, the regulatory environment surrounding cryptocurrencies remains uncertain, potentially impacting their legitimacy and adoption. Ultimately, understanding these advantages and disadvantages is crucial for anyone considering entering the cryptocurrency market, as they navigate the complexities of this evolving financial frontier. Central banks play a crucial role in modern economies by regulating the money supply and maintaining economic stability. One of their primary functions is to control inflation, ensuring that prices remain stable over time. They achieve this by adjusting interest rates, which influences borrowing and spending behaviors among consumers and businesses. When economic growth is sluggish, central banks may lower interest rates to encourage borrowing and investment. Conversely, if the economy is overheating, they might raise rates to cool down inflation. Additionally, central banks act as a lender of last resort, providing liquidity to financial institutions during times of crisis to prevent bank runs and maintain public confidence in the financial system. They also oversee the payment systems, ensuring that transactions are processed smoothly and securely. By managing foreign exchange reserves, central banks help stabilize their national currency in the global market, contributing to overall economic health and stability. Their multifaceted role is essential for fostering sustainable economic growth. Globalization has profoundly influenced the landscape of money, particularly through international trade. As nations engage in cross-border transactions, currency exchange rates fluctuate based on supply and demand dynamics. When a country's exports increase, its currency often appreciates, making imports more expensive. Conversely, a trade deficit can lead to currency depreciation, impacting purchasing power. Economic policies have also evolved in response to globalization. Governments now consider global economic trends when formulating monetary policies, aiming to attract foreign investment and stabilize their currencies. This interconnectedness means that economic events in one part of the world can ripple through to others, creating a complex web of financial relationships. Additionally, multinational corporations often engage in currency hedging to mitigate risks associated with exchange rate volatility. As a result, globalization not only reshapes how money is perceived, but also how it functions within the global economy, driving innovation and necessitating adaptive strategies for both businesses and governments alike. As we move further into the digital age, the concept of money is evolving rapidly. Cashless societies are becoming more prevalent, with countries like Sweden leading the way. The convenience of digital transactions is reshaping how we conduct business, making physical currency less necessary. This shift raises questions about the future of traditional banking and the role of cash. Additionally, new forms of currency are emerging, such as cryptocurrencies and central bank digital currencies. These innovations promise increased efficiency and security in transactions, but also bring challenges, including regulatory concerns and potential volatility. The rise of mobile payment platforms and digital wallets is changing consumer behavior, pushing us toward a more interconnected financial ecosystem. As we explore these trends, it is essential to consider how they will impact our daily lives, economic systems, and the very definition of money itself. The future of money is not just about technology, it is about reimagining our financial interactions. As money systems evolve, they bring significant social implications that can exacerbate wealth inequality and affect access to financial resources. In traditional systems, wealth often concentrated in the hands of a few, leaving marginalized communities without adequate access to banking services. The rise of digital currencies and financial technologies offers potential solutions, but also poses risks. For instance, while cryptocurrencies can provide financial inclusion for the unbanked, they also require technological access and literacy, which not everyone possesses. Furthermore, as financial systems shift, the gap between those who can adapt and those who cannot widens. This disparity can lead to social unrest and a lack of trust in financial institutions. Addressing these challenges is crucial for creating equitable systems that empower all individuals, regardless of their socioeconomic status. Ultimately, the transformation of money systems must consider the broader societal impacts to foster inclusive economic growth and stability. The production and transactions of money, both traditional and digital, have significant environmental implications. The manufacturing of physical currency, such as coins and paper bills, involves resource-intensive processes that contribute to deforestation, water pollution, and high energy consumption. For instance, the production of paper money requires trees, while minting coins demands metals, often extracted through environmentally damaging mining practices. On the other hand, digital currencies, especially cryptocurrencies, also pose environmental challenges. The process of mining cryptocurrencies like Bitcoin consumes vast amounts of electricity, often sourced from fossil fuels, leading to increased carbon emissions. Additionally, the infrastructure supporting digital transactions, including data centers and networks, require substantial energy. As society increasingly shifts towards cashless transactions, it is crucial to consider sustainable practices in both traditional and digital money systems. Addressing these environmental impacts is essential for ensuring a healthier planet while navigating the future of currency. The evolution of money has been a transformative journey that shaped modern economies. It began with the barter system, which, despite its limitations, laid the groundwork for trade. The introduction of commodity money such as gold and silver marked a significant advancement, providing intrinsic value and facilitating transactions. This was followed by the minting of metal coins in Lydia around 600 years before Christ, which standardized trade and increased commerce efficiency. The invention of paper money in ancient China during the Tang dynasty further revolutionized trade, allowing for larger transactions without the burden of carrying heavy coins. As paper money spread to Europe, it faced challenges but ultimately became widely accepted. The establishment of banks and promissory notes enabled trust in larger transactions. The gold standard provided stability in the 19th century, while the Great Depression led to the rise of fiat money, setting the stage for today's digital and cryptocurrency innovations. As we reflect on the ongoing changes in the concept of money, it is clear that we are witnessing a remarkable transformation. From the barter system to the introduction of cryptocurrencies, the evolution of money has been driven by the need for efficiency, security, and adaptability. The rise of digital transactions and the potential for cashless societies suggest that the future of money will be increasingly virtual, presenting both opportunities and challenges. Society must navigate the implications of these changes, including issues of wealth inequality and access to financial resources. Additionally, the environmental impact of both traditional and digital currencies cannot be overlooked. As we move forward, it is essential to consider how these developments will shape our economies and daily lives. The future of money holds the promise of innovation, but it also requires careful consideration of its broader social and environmental consequences. Embracing this evolution will be crucial for creating a more equitable and sustainable financial landscape.